And of course, heading into these G20 meetings in Korea, there's a lot of focus continuing to be on the US and particularly China, keeping up this drumbeat of criticism over the Fed Reserve's move to restart quantitative easing as they try to kickstart the economy and, of course, avoid deflation or discourage deflation. Global leaders are worried about it flooding the world with cash, causing instability. And there's also a bit of debate underway in the United States about the way in which the Fed Reserve's gone about reinstating this quantitative. Let's get the view of Stephen Nash from FIG Securities. Stephen, we wanted to ask you a little bit today about obviously the inflation hawk's going crazy, and we're speaking to commodities guys all the time about that. But there's a bit of debate underway and criticism maybe about the Fed's decision to concentrate the buying power on the shorter end. So the Treasuries were maturing 7 years or less as opposed to like that longer end, the 30-year. Just explain to us why that sparks so much debate.
Well, I think the long end of the US bond market has been affected by ongoing perceptions of a V-shaped recovery. You can see that in the equity market. It's been quite buoyant since the Jackson Hole speech, and I think that's affecting the 30-year pricing at the moment, in the sense that people expect a dip, that it will allow them, in terms of growth, it will allow them to buy the 10-year, but the 30-year is just too much at the moment. So in the short end, you've got people accepting the Fed or not fighting the Fed, but in the 30-year, there's a big fight going, and at the moment the market is not taking the Fed's guidance on board there.
What is that rationale behind the Fed? I think it was something like 2/3 of the purchases will be at that shorter.
I'd imagine that this is the first instalment in terms of guidance from the Fed, and that may change over time, and there may be more attention paid to the long end. As you know, 30-year mortgages are very important for lending in the US. As rates change, there will be changes in the borrowing pattern from the short end, maybe going out to 10 years. But I imagine that 30-year rate is quite important.
Well, and yet why the lack of emphasis? Because if the yields are only spiking now at the longer end, so then therefore the cost of lending is only going to get higher. Is that just simply a psychological device the Fed's trying to create, that jump now on the shorter end for people, take out the shorter dated the loans that are on offer there, because it'll actually pay you to do that than sitting on the sidelines?
Well, I think the Fed's taking a fairly conservative stance in the sense that you can't take the whole market on. It's sort of targeting one part of the market, and it's affected those yields already. I think over time that emphasis may shift further out. It will take a while for people to accept that growth will be lower for longer. I think people have already accepted that. Just going back 6 months, people were expecting rate rises in the US fairly, within 6 to 12 months. Now that's been pushed way out. I think that procedure will continue, and that the idea of growth will be pushed out. It may lead to some weakness in equity prices, and then the 30-year should rally somewhat.
Well, these inflation expectations are leading a lot of the commodities guys to say, you're looking at cotton prices, the shirt on your back getting so expensive, the petrol in your car, that's likely to go up. Got all this bullish calls about oil. What do the bond markets say? What's the view of how this will affect the consumer?
Well, there's been, I think this is really to do with the level of the US dollar, and one of the ideas with that is that they want to have import prices a lot lower. I mean, they don't want inflation to take off. So I think that commodities are only part of the story here.
Okay.
Yeah.
So, I mean, in the short term, how to play this at G20? The fact that, if anything, China's currency's obviously still pegged to the dollar.
Yep.
It's seeing losses on its investments all the while. I mean, is there going to be a fight back? What is China's stance going to have to be?
Well, as I've said a few times, I think that the US is getting a little bit frustrated with other countries effectively renting out their consumers, and they're still the largest consumer market in the world, and they do have quite a bit of firepower there, and I imagine that there will be accelerated moves to increase the value of the Chinese currency. I think there'll be increased pressure there, and there may be some developments there. I think that may also affect Chinese growth going forward.
And we continue to talk about this spillover of European debt concerns to the rest of the world, how will it affect us? But what about how QE2 then spills over into that European picture?
Well, what we've been seeing in Europe, I think, is really interesting. It's like European debt crisis 2 is following QE2 in effect. With Irish spreads moving significantly wider, there's a concern in the market that that could affect the UK banking system in particular. There's a 4-year plan due by the Irish quite soon, and there's a anticipation that there could be a downgrade of the Irish government as a result of that. That could flow on through to higher funding costs in the UK banking system. And again, that will crimp growth in the UK. So there are wider implications.
Just a brief final thought on funding costs as well, and bringing it back home. Combank talking about this retail bond offering to try and, I guess, broaden its pool of funds, focus on the domestic market, and also get investors into a different mindset, not just hostage to equities or commodities. Along the road on that one, it's just kind of an announcement from there, nothing beyond that. What are you looking at? Is it going to take flight?
Okay, well, the self-managed super fund market around 330 billion at last estimates, probably larger than that now. We think the under-investment in fixed income is probably 10 to 20%, so the potential size of this market is huge. So the CBA announcement is really important. I think it could open up investors to the idea of fixed income. Hopefully they could follow it up with maybe a fixed offering. We think that investors should have more interest rate exposure in their portfolios to offset equity risk. This is a floating rate offering, but hopefully this is the start of a lot more in this market. I think it's a very important development.
Okay.
Stephen, we have to wrap up for now, but we look forward to chatting to you next time as well. Thank you.
Cheers.
Thanks, Stephen Nash from Fixed Securities. We could always chat for much longer, but we have to take a break here on Market Express. Back in a moment.